Yeah, I mean, look, energy's not defensive right now. Okay, if this banking crisis gets worse and turns into something more serious, oil's going lower, and so I think that's something people have to keep in mind. But if you want to look through it and play a recovery, one thing to point out is that there were some signs of oil demand starting to get better right before SVB. Consumer confidence was pretty high, economic growth was getting revised higher, and refining margins are actually really strong. And that's one thing that's very different between now and say 2008.
Yeah,
In 2008,
go ahead.
refinery margins have been going down for a year, and now they're stable. And so maybe the end market's a little bit healthier than what the price suggests.
Is that a structural difference or just a cyclical one versus last time?
Well, it's structural. Refining capacity shrank in 2021 and 22 for the first time in 40 years. So nobody's really seen it before. It's very unusual for global refining capacity to go down on a net basis. And so supply is definitely a factor there. But again, if it was really a demand issue that was 2008-ish, you would see it in refining margins too, irrespective of where capacity went.
You say that you think the outcome from all this, and I guess that's just the whole complex of issues that are affecting energy and the economy right now, will be an M&A wave. Explain that. Who will be the buyers and who the sellers? Yeah,
well, so when energy companies do M&A, they have to mark to market the assets that they buy at the oil price that at that time. Ooh. And so when oil's 100, you put a lot of assets on your balance sheet and you run the risk of impairments and you have a very high rate of depreciation. When you have a pullback like this, it's a much more accommodative environment to add assets. And if energy companies are constructive on the outlook, this is the window for them to deploy balance sheets. Exxon and Chevron have paid down all of their debt over the past 2 years. So the capacity is there.
And who would be the targets?
Well, you have to look at relative value. I think one that stands out on a comp sheet is Occidental. And again, like, you know, it's very speculative, but it's got a really high free cash flow yield. It bolts on very easily. The assets are attractive. And so at the very least, even if it's not a consolidation candidate, at least it's a value play.
But this is not an administration that particularly likes big oil. Wouldn't they stand in the way of a merger at that scale?
Well, one thing that's going to raise red flags is if companies combined and then reduced activity or somehow made actions after the fact to constrain supply. But I don't think that would happen in this case. I think when you have if you have an M&A wave in this market, it would probably just put assets in stronger hands and probably make supply more stable in the long run.
And let's not forget they just greenlit that Alaska project as well. I mean, you would have thought this was a much friendlier, or you could argue, okay, more supply comes online. Is that bullish or bearish, Sam?
Well, it's not for a while. So if you can predict oil demand in 2027 when the project comes on, you can have my job. But anyway, I do think that it was a sign that supply is top of mind, and the administration is focused on protecting consumers with more capacity.
All right, very good. Can't even predict it for tomorrow. Couldn't even tell you what it was today. Sam Margolin, thanks for your time. We appreciate it.